Hello everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we will be looking at the key lessons from the legendary investor, Warren Buffett, in his letters to shareholders over the last 40 years. Warren needs no introduction. He is the chairman and CEO of Berkshire Hathaway, one of the most robust conglomerates with business covering insurance, railroads, food and beverages, and even tech. Warren Buffett started investing at the age of 11, and in the last 80 years, he has generated several hundred billion US dollars and personally has a net worth of around 100 billion US dollars. This is despite pledging and actively giving away his wealth for philanthropic purposes. This will be a multi-part video series, and in this part 1, we will be covering 2 key lessons on stock ownership shared by Warren Buffett in his shareholder letters. So before we start, if you're interested in this topic, please smash that like button so others can view this video as well. Now let's dive into the 2 key lessons on stock ownership. Lesson number 1. Buy stock as an owner, not as a speculator. When many investors buy stock, they become price obsessed, constantly checking the ticker to see if they are up or down money on any given day. But Buffett's perspective, buying a stock should follow the same kind of rigorous analysis as buying a business. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. He wrote it in his 1996 letter. Rather than getting too caught up in the price or recent movement of a stock, Buffett says, buy from companies that make great products, that have strong competitive advantages, and that can provide you with consistent returns over the long term. In short, buy stocks in businesses that you would like to own yourself. Whenever Charlie and I buy common stocks for Berkshire's insurance companies, we approach the transaction as if we were buying into a private business, he wrote in his 1987 letter. We look at the economic prospects of the business, the people in charge of running it, and the price we must pay. We do not have in mind any time or price for sale. Take his investment in and later acquisition of the auto insurer GEICO, an acquisition that has been called Buffett's best ever. In 1951, Buffett made the decision to invest more than half of his net worth in GECIO. He increased his holdings dramatically during the bear market of the mid-70s, where GECIO was struggling. By 1995, he owned half of the company, and later that year, he arranged to buy the rest. Perhaps no other investment better represents Buffett's ideal as this 50-year-old investment in GECIO. Buffett concedes that those who invest in companies on the speculation that they may one day be worthwhile could reap returns. He just has no interest in that kind of investment. He prefers to invest in companies that are already successful, even if that success is undervalued by the market, and that have a strong chance of continuing success over the long term. That conviction gives him the ability to buy even bigger portions of the companies in which he invests when the overall market goes down the hill. With a speculator mentality, Buffett might have offloaded GECIO stock in the mid-70s. With a downturn in progress and health gains already realized, he would have come out ahead. With his owner mentality, however, Buffett used the downturn as an opportunity to amass an even greater share of the company. In 2013, Buffett reported that GECIO had generated 73 billion of Berkshire's Hathaway in 1 year. Not a bad single-year return for a company that Buffett took over for 2.3 billion. Lesson number 2. Don't ignore the value of intangible assets. Companies have both tangible assets, which include factory, capital, inventory, and intangible assets, which include things like reputation and brand. For Buffett, those tangible assets and intangible assets are the utmost of value-driven investors. But he also thought that those intangible assets are of the utmost importance for value-driven investors. But he didn't think that always. Earlier in his investing career, he admits he was a servant of the tangible assets only. He was taught to favor tangible assets and to shun businesses whose value depended largely upon economic goodwill. He wrote in 1983, "This bias caused me to make many important business mistakes of omission, although relatively few of commission." By 1983, however, Buffett's attitude had changed, largely because of the success of one of his favorite businesses at the time, See's Candy Store. In the early 70s, See's was able to produce about $2 million a year after taxes on just $8 million in net tangible assets. For a shop chain like See's, this far exceeded expectations, and the reason for it, according to Buffett, was that the company enjoyed a subjective competitive advantage in the form of a persuasive, favorable reputation with consumers based upon countless pleasant experiences they have had with both products and personals. Berkshire Hathaway bought See's, and by 1982, it was up to producing around $13 million after taxes on just $20 million in net tangible assets. When Berkshire Hathaway or anyone else buys a company, they pay a premium for the company's subjective assets. That premium is the company's economic goodwill. When Berkshire first acquired See's, they paid a small multiple to account for the fact that See's was able to earn around 25% of net tangible assets after tax, an impressive rate of return for a candy business. A few years later, however, See's was earning 65% of its net tangible assets after tax. Berkshire had paid a small premium upon acquisition to account for the company's subjective advantage over the other candy stores. But just a couple of years later, that advantage had increased and made See's an even more robust and profitable business. And this was an advantage that Buffett was beginning to see was inflation-proof. During inflation, the conventional wisdom has been that businesses with lots of tangible capital resources were the best bets. With their factories and machinery, the thinking went they could better weather the market impact of widespread lower purchasing power and higher costs. However, Buffett's findings said that asset-heavy businesses generally earn low rates of return that often barely provide enough capital to fund the inflationary needs of existing businesses. Because of the success of See's, Buffett realized that companies with relatively few tangible assets and combined intangibles of lasting value, untimely, do best in an inflationary environment because they have less costs to cover and higher rates of return on their existing capital. During inflation, goodwill is the gift that keeps giving, he concludes, a lesson that will serve us as well as we see the historic inflation in US and other countries. For now, that's it from us. Hope you enjoyed and learned from these lessons. Subscribe to make sure you have received the follow-up videos on key lessons from Warren Buffett. Thanks for watching and smash that like button for more videos. Until then, goodbye.